Good morning, traders. John Caruso coming to you here for the morning of May 26th. We're headed into a holiday weekend here. We'll just kind of recap the market for you this week and take a quick peek at the currencies. First, this morning we did see Q1 GDP. We did see that get a little bit of an upgrade here. That came in at up 1.2%. The market was looking for 0.8%, so we got a little bit of a bump there. Durables were soft. That was expected. However, they came in less soft than expected, down 0.7%. The market was looking for down 1%. Another record-setting week on Wall Street. We do have the NASDAQ still pressing all-time highs. We put in an all-time high at 57.95.5 this week. The S&P 500 also posted an all-time high. Yesterday, the futures traded to 24.1775, and there's still time left here for those to topple those numbers as well. Growth is accelerating. That's the narrative out there. Earnings have been strong this quarter as well. That is also a narrative that keeps feeding stocks higher. How much higher can we press before seeing a little bit of a corrective setback? I don't think very long. I do think the market's getting a little bit heavy up here. One of the indicators that we've been following here for the past 2 weeks is implied volatility on the S&P 500 options, which has basically been sucked out of the option prices. What that means is bulls are starting to get complacent. The market's starting to look a little bit overbought up here. But that doesn't mean it can't get more overbought here in the immediate term. Yeah, keep that in mind. Complacency seems to be setting into the stock market. Looking at the currencies right now, the U.S. dollar, we're up 18.9735 right now after the bump in GDP. I got the top end of my range about 98.5 to the low end about 96.20. We are coming off of a dismal week for the U.S. dollar last week. We are starting to see it get a little bit of a bump into the end of the week. That could carry through into early next week, and then as the data rolls out, we're going to reassess that market. Inversely, another thing I want to hit on, it does seem as if the Federal Reserve is starting to get a little bit iffy on whether or not they want to go in June with an interest rate hike. So that's got dollar bulls a little bit nervous as well, and we're starting to see that reflect into the market. The euro consolidating, we've been consolidating pretty much all week at the top end of the trading range. The top end of the range is roughly around 113 to 110 is on the low end. So you kind of want to manage that range right now. We have seen European data, economic news and data come out better than expected here as of late. We do know that Draghi and the ECB are looking to taper at the end of the year. Is this the start of a taper rally? Perhaps. But I do think the market's gotten a little bit top heavy up here, and some corrective setback perhaps to the low end of the trading range is probably long overdue. Taking a look at the Japanese yen. We've been trading sideways to lower all week. Right now, there's really no need for a safe haven currency. We know the Japanese yen is a safe haven currency. We're trading right around that 90 level. I do think we take a peek at 89, so another 100 ticks lower. And that could be a decent time to start looking at allocating some capital towards the bullish picture of the Japanese yen. But we'll cross that bridge when we get there. We'll take a look at the market when it gets down to that level. So that's all I have for you right now. We'll catch you back here next week. I hope everybody has a great holiday weekend.